Hello and welcome back to HPD Trading's weekly fundamental overview video, where we're going to go over the main fundamental drivers that are going to affect the markets in the upcoming week and how we expect price to play out. So before I get into anything, I just need to say that this is not financial advice, this is our own opinions. So to start with, we want to cover the general risk sentiment that will be in the market this week. So I've plotted the VIX index here, which essentially measures the overall risk sentiment, and this red line here at the 20 level indicates when risk is prevalent and we should be, looking at safer assets, whether that's gold or a safer currency like the US dollar or the Swiss franc or the yen. So as you can see, we're just sort of hovering around that 20 level. And this is mainly due to the fact that Trump's inauguration is going to be next week. So with this inauguration, there is a lot of uncertainty around tariffs, etc., and therefore there is more risk. Obviously, coupling that with the war and tensions in the Middle East and Europe. So moving on to the US dollar, actually, we expect the US dollar to come in somewhere around this region for this week. The US dollar is the most bullish currency in our opinion, and this is due to a variety of reasons. So one of the main reasons is the fact that there are so little interest rates being priced in the market for this year, with only 1 to 2 cuts being priced in. This is important because wherever the interest rates are high or there's a lack of cut in interest rates, that's where the money will flow. Another thing to add on to that is Trump incoming next week. So his cabinet, his office is seen as inflationary, and therefore, with an inflationary environment, interest rates need to be either increased or held at higher levels for longer, and that will again just support the economy. So, with that and the strong job market, which we've seen through the NFP print last week, we expect the US dollar to just keep shooting to the upside. CADs is a bit of a trickier one. They don't seem to be doing too much at this moment. Last year they were cutting pretty aggressively, pretty consistently. However, now they seem to be at sort of a happy place where they can slow down on the cuts and the size of the cuts. So we expect the Canadian dollar to just sort of range somewhere in here, not really going too much higher or too much lower. One thing to note is the threat of the Trump tariffs. We do believe that this is just Trump talking himself into a negotiation power play, where we don't expect whatever he's saying to actually come true, to be honest. We expect it's just more of a negotiation tactic. Pounds, last year the pound performed pretty strongly. However, over the last sort of week, it's really taken a tumble. That being said, we do expect this to be sort of a short-term tumble. We expect these lows to be taken out, and then from there, potentially start reversing back to the upside for at least some time. One thing to note in terms of the weakness of the pound is the fact that the GDP growth rate shrunk massively last quarter, with it coming in at only 0.1, indicating that negative GDP growth is not too far away. However, in terms of supporting the pound, there's only 2 policy cuts expected for 2025, so that would help boost up the pound. In terms of the euro, however, we see this being the weakest currency, or one of the weakest. This is mainly due to the fact that 4 cuts are expected for the euro. And again, like I mentioned earlier, more cuts means weaker currency. Coupling this with the seasonal tendency to fall against the dollar in Q1 and the calls for parity with the dollar, we're expecting the euro to at least take out this low this week, potentially this low, although that could potentially be next week with Trump coming in. And then if it reaches parity with the dollar, it could potentially come to round about this region. One thing to note is the Eurozone, the head honchos of the Eurozone is France and Germany. However, right now they are experiencing a lot of political instability with elections upcoming for, key prime minister and other positions. So that's leading to uncertainty into the market, and uncertainty usually means the currency will fall. Lastly, the Eurozone keeps producing poorer and poorer manufacturing rates, again pulling the euro down. The Swiss franc, there's not much to say for the Swiss franc, to be honest. Last year it performed pretty consistently. You can see it's just been ranging due to the overall risk sentiment in the market, and with it being a safe haven, it's a pretty consistent bet. So honestly, we expect just sort of a range here. I don't want to spend too much time on that. The yen, as the central bank of Japan, the Bank of Japan, is looking to hike rates. They're one of the only, well, the only currency looking to hike rates out of the currencies we look at. However, they keep playing a sort of cat and mouse game. As you can see here, we're consolidating, and then there was rumors of a hike coming, and then they pushed it back, and then now the cycle seems to be repeating again. There's the rumors have started up of the hike coming soon. So we expect with these rumours price to keep pushing a bit higher, maybe come into this level around the 1.35 level, and then from there it really depends on what Japan wants to do, whether they actually want to be clear with their plans or not. China, in terms of China, we don't really trade China, we just look at it as a temperature gauge for some of the other Antipodean currencies. The Chinese government have expressed their openness to cutting rates. Again, that would bring the Chinese yuan down, coupling this with the fact that they had to unleash economic stimulus last year due to the inflation rate being so low, as well as things like the property sector market being a complete mess. We're expecting the Chinese yuan to fall essentially based off this, and one of the key things is the inflation rate being only at 1.01%. So with this being so low, there is the risk of deflation, and deflation is really I can't think of the word, but it's not good news for a currency. So with deflation, people decide, well, prices are going down, they're deflating. So why would I buy it now when I could wait 1 month and I'll buy it for cheaper? And then it gets to that next month and they don't buy it then because they could get it for even cheaper the following month. And then this vicious cycle repeats and repeats. And then nothing is bought and the GDP sinks, etc. And the currency becomes a total riot. So with this in mind, we are expecting the Chinese yuan to fall. Following on from that, and additionally, actually, I should have said the fact that Trump is coming in soon and all his Chinese tariffs, they're only going to weigh on Chinese sentiment. And this leads nicely into the Australian dollar, which is a Chinese proxy. So all of the Trump news will affect the Australian dollar, as we can see here from October when Trump was being pegged as the favourite to win the race for the White House. From there to his, announcement as the winner and onwards, the Australian dollar has just fallen slowly but surely. So we expect the Australian dollar to keep following this trend. Adding to this is the start of them cutting their interest rates. So over the next week, we'd expect this low to be taken out, potentially these lows as well. However, they may be kept in play and taken out in the following week when Trump is in office. And lastly, the New Zealand dollar, which is also a Chinese proxy. So basically, a Chinese proxy is due to the both New Zealand dollar and the Australian dollar. Their economies heavily rely on exports to China, and therefore whatever affects China affects them. So in a similar fashion to the Australian dollar from Trump's sort of favoured odds of winning, the New Zealand dollar has just fallen and fallen. However, it's fallen a bit harder and faster than the Australian dollar due to the fact that last year, and this trend is expected to continue this year, of 50 basis point cuts being expected and actually happening. So the New Zealand central bank keep cutting interest rates pretty consistently and pretty heavily. So with that, we're expecting these lows to be taken out either this week or next week. There is potential, however, for price to sort of meander back up to in this sort of region and then sort of come down the following week. But over the next couple of weeks, we expect these lows to be taken out. One thing to note is the fact that the GDP growth rate is negative, and that is obviously, bad news for the New Zealand economy. It's going to mean that they are going to have to keep cutting rates. So that brings us to the end of the presentation. I've tried to keep it as short and sweet as possible so you can, get the main important points of the market and get a better understanding of what's going to be driving the market this week. If you have any other questions, feel free to comment and we'll get back to you in the comments below.